Welcome to Expert Talks by Kalkine TV. I'm Sage, you're watching the Executive Corner. And today's guest is Mr Darren Abrams, the Managing Director of Oz Merchant Investments. And Oz Merchant Investments' goal is to bridge the gap between traditional and digital finance and offer wholesale investors a reputable, regulated option to invest in the blockchain space, a digital currency provider for investors and businesses. So, as you know, we bring you the business leaders to help you understand the insights of the stock market. And today we're very lucky to share some space live with Mr Darren Abrams, the Managing Director of Oz Merchant Investments. Welcome to the show, Darren.
Thank you very much for having me.
Well, with your wealth of experience behind you, I'm keen to get the discussion started. And Ether, the cryptocurrency of the Ethereum network, is arguably the second most popular digital token after Bitcoin, and indeed as the second largest cryptocurrency by market cap. Comparisons between Ether and BTC are only natural. And as a market expert yourself, what would you like to tell our viewers about the differences between Bitcoin and Ethereum, and what sets them apart, please?
Sure. I think a great way to summarize it would be to say that Bitcoin is to gold what Ether is to equities. See, Bitcoin has been aptly described as dumb, and that is by no means a dig at the revolutionary discovery that Bitcoin is. What it means is that Bitcoin's purpose is simple. It's a digital form of money. It's also censorship resistant, as it's maintained by an international decentralized network of computers, all of whom have a copy of that same distributed ledger. No third parties are needed to utilize the network, nor can any deny an individual's ability to do so. Bitcoin is also a particularly effective store of value, much like gold. Bitcoin and gold are both forms of hard money, and the central investment thesis for both assets are that they are an effective hedge against inflation. Unlike the supply of fiat currencies, as measured by the M2SL money supply, which can be increased by central banks to assist with economic goals, the supply of both Bitcoin and gold are finite. One may ask, why is this even important? The answer is very clear when you assess the purchasing power of the dollar, which has consistently decreased over time as the monetary supply increases. The investment thesis for Bitcoin doesn't assume that the world economy and the US dollar is about to implode. The thesis revolves around the fact that the amount of money being injected into the financial system by central banks is unsustainable. We are beginning to see the effects of this massive expansion of the M2SL monetary supply in the form of inflation. And inflation acts as a silent tax. Without having your money yielding a higher interest rate than that of inflation, the dollar value of your savings may stay the same, but their purchasing power will be diminished. Bitcoin's price appreciation has consistently outperformed the rate of inflation, which makes it an excellent way to preserve savings. Ethereum, on the other hand, and its native token Ether, are far more than a form of digital money. Ethereum's ability to facilitate smart contracts is a paradigm shift from Bitcoin. Ethereum is essentially a platform upon which a multitude of decentralized applications are built. These decentralized applications, or dApps as they are referred to, are part of a revolution in the computing space known as Web 3.0. Web 3.0 is powering a new era of decentralized finance, or DeFi for short. Among a myriad of other uses, dApps allow users to borrow, lend, swap, utilize derivatives, and earn yield on their digital assets, and it's done in a permissionless manner. Rather than having financial gatekeepers decide who can and can't utilize these financial applications, it's all executed via software, i.e. through effective use of these smart contracts. All of the dApps built on top of Ethereum utilize Ethereum's native token Ether to pay for miners to process transactions. Therefore, from an investment perspective, having exposure to Ethereum by holding that Ether token affords the investors exposure to all of the dApps built on top of that blockchain.
Fantastic. Thank you for that summary of quite a high-level concept. And I think proof of stake and proof of work, the methods that are used to mine both Bitcoin and Ether, are also quite different as well, which is an interesting point. So thank you so much for that, Darren. And Bitcoin and Ethereum are both crypto colossi. One was the first digital currency and the other was the first crypto to launch the all-important smart contract. And moreover, they are the top two cryptocurrencies by market capitalisation, both increasing by the day, and tend to be the yardsticks against which all the other cryptos are measured usually. So when comparing the two coins, what does Bitcoin and Ethereum, what do they have to have in common?
So as I alluded to earlier, both are decentralized. Both are also cryptographically secured blockchain platforms. They both allow for permissionless, censorship-resistant peer-to-peer transactions. From an investment perspective, what Bitcoin and Ether have in common is that they are both forms of hard money. Ether is currently in the process of being upgraded, and one of the changes being executed will dramatically reduce the inflationary rate of the Ether token. This means that both digital assets will be useful as a hedge against inflation and therefore an effective store of value.
Fantastic. And that issue of inflation is definitely on the forefront of many investors' minds at the moment. So it's going to be interesting to see how cryptocurrencies play a part in hedging against inflation. So cryptocurrencies have experienced waves of volatility over the past year without a doubt, but they're steadily gaining traction among the investors, institutional as well. And in regards to the Bitcoin versus Ethereum debate that we're having at the moment, or discussion, or even Cardano for that matter, which cryptocurrency is a buy in your opinion, please, Darren?
Sure. Well, firstly, to speak to the volatility. Volatility is a product of a nascent asset class, and it isn't exclusive to digital assets. In fact, the price of gold was particularly volatile in the decades following the US abandoning the gold standard. Volatility is essentially the price investors pay for the parabolic price appreciation. That being said, as this asset class matures, the volatility will diminish, as will the parabolic price movements. This holds true for Bitcoin, Ether, and Cardano. However, new technologies will inevitably result in new tokens that will each need to mature independently with respect to that volatility. So what's interesting is that when you look at the traditional 60-40 portfolio, allocating 1 to 5% to Bitcoin since 2015 would have been a very profitable decision. And now that's obviously no surprise considering the trajectory Bitcoin has had. What may surprise the investors is the positive impact on this allocation with respect to risk-adjusted returns. Using the benchmark Sharpe ratio, a recognized measure of the trade-off between volatility and gains, showed an improvement for all levels of crypto exposure considered, i.e. between that 1 and 5%. Earlier this year, an analysis by JP Morgan & Co. suggested that exposure to Bitcoin could achieve an efficiency gain in risk-adjusted portfolio returns. Which digital assets have the most compelling investment thesis? This answer will change over time. Oz Merchant Investments is always trying to find asymmetrical investment opportunities, which are far more prevalent in the crypto space than traditional finance. However, the knowledge, skills, and time required to do so require a team of experts. Therefore, having a trusted, ASIC-regulated expert in the space managing your portfolio is, we believe, the ideal way to gain exposure to the asset class. Alternatively, investing in Bitcoin as well as the platforms powering the dApps is an advisable place to start. Specifically, Ether, Luna, Polkadot, Solana, Cosmos, and Avalanche.
Okay, so you've mentioned the majors there. Thanks for that. Definitely we'll keep them on our watch list. So just a quick question. In regards to using bots or algorithmic trading for faster analysis of crypto trades, would your company do anything towards that side of the business or not really?
Interestingly enough, we are actually in the process of developing a couple of different proprietary trading bots. The interesting learnings that we've had is that they deliver outsized results, but they still really do need that human intervention to be able to inform them of the prevailing market conditions so that they can act accordingly.
Thank you so much. And now back to the main line discussion. Do you believe that DeFi Savings is more flexible and efficient? The yield that can be achieved through DeFi in orders of magnitude is higher than bank deposits. But how is that possible, please, Darren?
So the yields achievable through DeFi are certainly far higher than traditional banks, and they will continue to be for the foreseeable future. The reasons are as follows. Firstly, there is a lack of regulation in the DeFi space. And now what this means is that when you compare it to banks, the cost of implementing and maintaining regulatory requirements for banks is particularly costly.
Thank you, Darren, for sharing your valuable insights on our show today. We really do appreciate your time. And if you've just joined us, we had a very interesting discussion with Mr. Darren Abrams, the Managing Director at Oz Merchants Investment. And the full recorded interview will be available from Kalkine Media's YouTube channel. So keep watching Kalkine Media for more expert talks, live market updates, and as we say, stay apprised and invest wise with Kalkine.